Welcome to Tony Byrne's View with news you can use. Tony has over 32 years of experience as a chartered financial planner and wealth manager. Tony's passion is to help you retire early and live the life of your dreams with no financial worries. Now to today's episode.
Welcome to today's podcast and thank you for listening. The subject for today is how to reduce your capital gains tax liability. Now, receipts from capital gains tax are expected to reach £9.1 billion in 2019-20, that is the last tax year. This compares with just 2.5 billion 10 years ago. So you can see capital gains tax revenue is rising quite a lot. That's a rise of almost 300% in 10 years. So you do have to be careful with this tax charge. Capital gains tax is charged on the profits made when certain assets, especially investments, are sold or transferred or gifted to other people. The main source of capital gains tax is from the sale of shares, and that's followed closely by residential property sales. And when we talk about capital gains and residential property, we're talking about investment property, not property that you live in as your principal private residence. Now, everybody, including children, and by children I mean minors, i.e. under age 18, everyone has an annual capital gains tax exemption, which amounts to £12,300 each in the current tax year. So any capital gains that you realise that fall within this exempt amount don't incur any tax. Now, if you make capital gains that exceed the annual exemption of £12,300 each, then the rate of tax you pay as a basic rate taxpayer is 10%, or 20% if you're a higher rate taxpayer. Now, for residential property, the previous rates of capital gains tax still apply. So if you're a basic rate taxpayer and make capital gain on residential property, your CGT rate is 18%. If you're a higher rate taxpayer, it's 28%. There's a further capital gains tax rate known as the entrepreneur's relief, which applies to the disposal of business assets that you've held for 2 years and that qualify for this relief. Capital gains are paid at a reduced rate of 10% tax. However, this used to apply to gains up to £10 million per person, but it was reduced to £1 million by the Chancellor Rishi Sunak in the budget on 11th of March this tax year. So let me just give you a few tips for how you can reduce your capital gains tax charge. The first one of these is use your allowance. The £12,300 CGT exemption is what we call a use it or lose it allowance. In other words, you can't carry forward this allowance into future tax years. But because each person has their own allowance, that means a married couple between them on joint assets have a combined capital gains tax exemption of £24,600. And also in most cases you can transfer assets between spouses and civil partners tax-free. So it might be worth considering transferring holdings, for example, in shares from one spouse or civil partner to another, especially if it's from a higher rate tax-paying person to a basic rate or zero rate taxpayer. What you can do as well, you can offset any losses you make against gains, which will give you a net gain or net loss. If you've got altogether net losses in one tax year, then you can carry them forward to offset against gains in the future, as long as you've registered those losses with HMRC, of course. Another way to avoid personal capital gains tax is to have your investments managed in a fund. So many listeners will already have their monies invested in what's called a general investment account with providers such as Parmenion or Standard Life, which we've advised on in the past, or even indeed in our sister company, Minerva Money Management's own fund, the CCM Intelligent Wealth Fund. Now, those gains within the funds are not subject to personal capital gains tax because it's the fund trading rather than you. So you don't have to worry about personal capital gains tax there. But if you do sell investments or even partial investments, you could become liable to capital gains tax on any excess above the capital gains tax exemption. So what you could do to reduce the risk is you could potentially just sell some of your holdings and then buy them back, and therefore reset the cost at a higher level than you originally paid for them. The trouble is tax rules stop you doing this because you have to wait 30 days before you can do what's otherwise known as bed and breakfasting. In other words, overnight selling and then buying back those shares. So you do need to be wary of that rule. But you can use the same bed and breakfasting technique by selling investments that are subject to capital gains tax and reinvesting the money in a pension, such as a SIP, and this is known as a bed and SIP, or reinvesting into an ISA, known as a bed and ISA, or even selling an taxable investment and your spouse or civil partner rebuying it back. Those ways you can avoid this 30-day rule, which just basically means you'd otherwise pay more capital gains tax. The reason it's called bed and breakfasting is because literally the time scale is so short, overnight in other words, it's the same length of time as staying in a bed and breakfast accommodation for one night, for example. Now, another thing you can do is to manage your taxable income levels. Because the rate of capital gains tax you pay, as mentioned earlier, is based on your overall rate of taxation in the year, mainly based on your income, then it's a good idea to try and reduce your income tax rate if you can. Now, a couple of simple ways you could do it. For example, one is to pay into a pension scheme, or another idea is, if you're already thinking of making gifts to charity, is to make a charitable donation, such as under gift aid. Now, not everyone realises this, but believe it or not, capital gains tax is not payable on death. There is this taxation rule that you don't suffer more than one tax on the same income or gain. So, because when you die, your estate is subject to inheritance tax, then no capital gains tax is payable. So, if you were, let's say, terminally ill, or in the later stages of your life, then it would be a bit of an own goal to sell assets, pay capital gains tax at anything up to, say, 28%, and then find what's left gets taxed at 40% on your death. That means you would inadvertently have been taxed twice. It's the proverbial own goal in tax terms. So another simple thing you can do, which most people fail to do, which seems incredibly obvious, but just use your annual ISA allowance. I've come across new clients who've come to us and they've got very large levels of investments. They've clearly not used their ISA allowance each year, probably not aware that those same investments most of the time could be reinvested into ISAs by two spouses or two civil partners. Between them, £40,000 each year could come out of taxable investments straight into the same investments again, but $20,000 each becomes a tax-free investment, which was otherwise taxable. Now, if you do that over a number of years, it'd be surprising how fast you can build up a large amount of tax-free investments, or certainly free from capital gains tax and income tax, rather than having very large sums still subject to capital gains tax. Now, what we do in practice is we remind clients to use up their ISA allowance each year, and if their money's managed by us, many of them automatically allow us to transfer investments out of their general investment account straight into their ISA, therefore avoiding capital gains tax, as long as that transfer doesn't itself trigger capital gains if they've got, for example, other gains during the year. Now, another thing that some people do, maybe some higher earners, perhaps more sophisticated investors, sometimes not such high earners or not such sophisticated investors, you might want to take advantage of something known as the Enterprise Investment Scheme, EIS, or the Seed EIS scheme, which allows you to reinvest the capital gains, I'll use that word carefully, not the proceeds, but the capital gains of an asset that's subject to capital gains tax, reinvest into these schemes, and you can defer taxation on those capital gains for at least 3 years, usually, sometimes a lot longer. These investments also have the benefit of giving you income tax relief at rates of 30% for EIS or 50% for Seed EIS. But I must say, to take advantage of that, you must bear in mind you have to have taxable income high enough to cover the capital gain that you're reinvesting. The other thing to be aware of is that such investments are high risk and they are illiquid. So even though technically you may have 3 years to sell your investment in an EIS scheme, in my experience it can be typically 4 or 5 years, sometimes as much as 7 or 8 years before the underlying investments become cash when the companies are sold in the future. So it can be quite a long delay there. So you've got to be very patient with this money and be very aware that it's high risk investment. Having said that, the tax reliefs are pretty substantial. These aren't right for everyone. The most extreme measure you can take to avoid capital gains tax, and this would apply, I would suggest, if you're already someone who was thinking of moving abroad, becoming non-resident, perhaps retiring, and you've got a large capital gain, perhaps from a sale of a very valuable business, you might like to consider becoming non-resident, because that way you can avoid capital gains tax completely, especially if, for example, you were to move to a tax jurisdiction on our doorstep, such as the Isle of Man and the Channel Islands. However, it doesn't come immediately. You have to be non-resident for more than 5 complete tax years after you've left the UK, after 5th of April 2013. So you would have to remain abroad and prove that you're non-resident for those 5 years. You would get the relief from capital gains tax straight away, as long as you've proven that you've emigrated and that you intend to stay abroad and remain non-resident and qualify for all those years. But do bear in mind also, just merely becoming non-resident isn't enough, because if you move from one country that has capital gains tax, i.e. the UK, and move to another one that has capital gains tax that's not an offshore tax haven, then you may be jumping out of the frying pan into the fire, and you may end up paying capital gains tax in that other country, although you've avoided it in the UK. So that's a bit of an own goal, I'm afraid. So if you're liable to capital gains tax, you can't choose whether to pay it or not. However, with careful planning, there are sensible ways to make best use of available reliefs and allowances to reduce your bill or even wipe it out altogether. As ever, it's always important to take advice from a professional before you take any action to save capital gains tax. You know it makes sense. So once again, thanks for listening. If you like this podcast, please pass it on to someone you know who may be interested.
Thank you for listening to today's episode. If you enjoyed it, don't forget to share it with your friends and family. For more information, head to www.wealthandtax.co.uk.